All right, cool. So welcome everybody. So this is Apartments 102. In this series, we have actually many interesting topics to talk about. Today, we'll be talking about the life cycle, of buying an apartment. Kind of different than a residential. I'll kind of explain the differences. So quick disclaimer, not a broker, not a real estate agent or an attorney. Everything that we say here, is just for educational purpose only. If you are interested in learning more or, being part of our apartment acquisition network and want to be notified of any future deals coming up, please feel free to join our newsletter. Okay. So the link is pretty straightforward. It's bit.ly /link_newsletter. I'll also post that to our chat in case you guys want to go ahead and register for the newsletter. That's the best way to get the latest news, and you can also reach out to me that way. Okay. Cool. So the agenda for today, I'll do a quick introduction about Link Multifamily, my investment group, and then we'll talk about the whole flow of buying and selling your property, right? So we'll cover what kind of preparations we should do before we make an offer, how we go about purchasing a property after you have bought it. The next one is how do you actually operate it through the 5-year, 6-year, whatever whole period that the strategy is. And finally, when do you consider an exit, under what conditions, and what are some of the typical strategies people use when exiting deals. So this is a part of the series. I plan to do quite a few because each one of them deserves its own topic, right? So the next one, Apartments 103, is going to be how to underwrite deals, right? How do you make your business projections? How do you look at a deal and quickly determine if it's a good deal or not, right? There's a lot of insider details on how this is calculated. I may actually break it up into 2 sessions, but we'll see how it goes. Apartments number 104, we'll talk about how to get your loans, right? How to get the bank to borrow up to 70 to 80% of the money, or even 100% to do your projects. And then the next one in the series will be, how do we actually manage a property? What are all the little daily things that, go wrong or go right? And, I'll share my experience on managing large size properties. Okay. And 106, goes into much more details about actual selling the property, actual refinancing in the middle of a hold, what that would look like. So I kind of put it towards the end because I'm actually actively selling one of the assets in my portfolio. We're selling a 146 units apartment in Dallas, in a city called Arlington, Texas. So it's in the Dallas-Fort Worth metro. So that one's being sold. We'll call for offers probably in about another 2 weeks or so. And we'll probably close by end of the year. So by that time, I will have a lot of things through the experience to share with you guys. And finally, I'll share a little bit about how I went from basically a software engineer to investing, in single family overseas, and then eventually making the jump to multifamily. So I think that will resonate with a lot of people here. So, and between one of these, I'll find a time to also do a recap of the Old Family Multifamily Conference. So once a year, the large multifamily operators would gather in Texas. And so we just had a conference last week talking about what is the current state of the market, etc. So I think it'll be good to do another one of those sessions outside of these Apartments 101 series. Okay. Any questions so far? Okay, moving on. So a little bit about who we are. Link Multifamily, we're basically a group of investors. We mostly live in California. Not all of us, but although we live in California, we don't invest in California. We invest out of state where where it is much more landlord friendly, where we can get much better returns than we can within California. So far, we've acquired about $35 million worth of assets. So actively managing about 350 units. And within the group, we raised about $6 million in funding to acquire these properties. So even though initially you'll see from the picture, it's mostly people who are fairly local to California, but as of now, we have a much larger group, and we have investors from all over the country. So aside from the meetup, we also have a separate investment group. So whenever we have an apartment that we have purchased, and we usually buy it together as a syndication. So we have a larger group, so that's the mailing list. And so when we have deals, we will do a presentation session to see, and whoever interested in investing will join at that time. So we're actually a pretty good sized group, so we're acquiring larger and larger properties. Nowadays, we're looking at deals, I would say anywhere from $20 to $40 million range. So, with more people, with more people interested in apartments, we can scale up to even larger and larger assets. I think Jason was asking, why are we selling? Well, the market right now is doing really good. So the property that we're selling is an older asset. This is a 1969 property. So this is 146 stores. And, when we purchased it, it was around 11.7 million. So it was around 11. We probably put in about 3.5 to 4 million of investors total. We probably put in about 3.5, and we already doubled that, right, in about 3 years. So I think we're good to go. So we bought it for about 11 million. Right now it's looking like it'll go north of 17 in 3 years. So it's pretty good. And we're transitioning to newer properties as well. So that's why we're selling. So typically apartments break up into 3 classes. Class A is basically less than 20 years. These are going to be your 4 to 5 stories tall with mixed retail on the bottom type of assets, right? That you frequently see. And then the Class B are the garden style, maybe mid-rise, up to about 2 to 3 stories tall. So these tend to be built in the 1970s, 1980s, some in the 1990s. Okay, so these are the age of the apartments really kind of determine their class. Okay, so Class C is probably a 1960s build, and about so 1960s build, flat roof, and about 2 stories tall. So that's kind of where we're seeing. Okay, so in terms of what we buy, we typically buy Class B and Class C assets, right? So our investment strategy is we like to invest in properties that do really well during downturns. So during downturns, people usually move down from more expensive places. That's why you'll see like Class A properties tend to give out like 1 month or 2 month free, while those people have moved down to Class B or Class C assets, right? So during the recession, during COVID, etc., Class B and Class C properties stayed completely full. I mean, like over 92% occupancy on average through the whole COVID period. We had no problem collecting and being able to collect, and maintaining our occupancy. So also the nice thing about Class B and Class C assets is there's usually things to renovate. So you can improve the value of the property and also increase rent with that. So a little bit about the team. So we, our acquisition team is about 3 to 4 people. So I have 2 partners that I'm working with in Dallas. So Ken and Wind are our partners in Dallas. They're our foot on the ground when we acquire Dallas properties, right? So Ken and Wind have already been doing apartment acquisition for quite a while. So far they bought about 15 apartments total and already full cycled about 7. So the partnership has a pretty strong track record. They started off by buying single family homes, and they actually purchased all the way up to about 72 single family homes before they felt that was way too much trouble. It's hard to scale, and they decided to just go buy 100 unit apartment. So you can get an equivalent of 100 single families while you're really only having to manage 1. So scaling really helps. So a little about me. My background is in software engineering. I basically grew up in Silicon Valley. I worked in Silicon Valley, and I still really enjoy coding and building stuff. And I'm a startup kind of guy, right? So when the company gets too large, I start to look for other opportunities and other startups. So I'm on my 5th startup. So actually 4th startup. So, I think I was lucky enough to be involved in a couple of IPOs, and I took that money and started investing in real estate. So I started off by investing in China, investing in flats and condos over there. Those did pretty well, but I want to pull the money back for more stability. And that's when I started looking around to see, what are all the good investments in the area, right? So I went to a lot of meetups like this one. I went to see what other people were putting their money in. And in the end, I think apartments fit my profile the best, right? So my thing is, in a downturn, I don't want to lose money, okay, or try not to lose too much money. So capital preservation is my main thing. So I invest in a lot of self-storage and apartments, which tend to do really well, even when the market is not so hot. Okay. So I started off by investing in the deals that other people's run. So I invested myself in about like close to 4,000 multifamily units now in about 14 different apartments. So this year, quite a few of them sold. So I think 5 of them went full cycle in about 4 years, 3 to 4 years. So, and we own, I'm sponsored. I sponsor about 3 deals right now. Okay. And in general, I really enjoy this line of business. I mean, I like to get out. I like to learn stuff. I like to, get my hands dirty, walking to apartments and everything. So, and I enjoy sharing information. So feel free to ask me questions or, reach out to me offline. I'm happy to grab coffee or even do a Zoom session, and, we can see how we can help. All right. So typically, this is typical for a Class C unit. So the general strategy is to renovate it and be able to rent it for a higher price, right? So doesn't look so good right now, but after renovation, it looks pretty damn good, right? And this only costs us about $3,000. When we buy apartments, when we buy granite, if we're buying appliances, we're buying 200, 300 of them. and we get rock bottom prices. So for example, granite that usually costs $1,000, or even $600 a slab, for us it only costs $100 a slab. Appliances cost about $200 each, because it's not just me buying, it is all the other apartment owners in the area that are buying, and collectively we're buying 2,000, 3,000 appliances a month, right? So within the whole DFW area, all the apartment owners know each other. We work with large property management companies, and we really have very strong buying power when sourcing these things. So that's a nice thing about apartments, right? Your ability to scale, and once you scale, things are literally like half price, or even at a quarter of the cost. So, which is really, really nice. Yeah. Okay. Moving on to the main topics of the day. So we're talking about, so buying a large commercial multifamily is pretty different than residential. So residential, you're working with individual buyer agents who show you listings, and then there's a lot to select from, right? So there's probably 30, 40 properties out there for you to choose from. And your buyer agent kind of walks you through it, right? In a multifamily, commercial multifamily, so anything that's 5 units and above is considered to be commercial sized. So, 1 or duplex or 4plex, those are all considered to still be residential with residential loans. When you move to 5 units and above, now you're doing commercial loans, which are actually much better, in my opinion. You get better rates, you get much better protection in terms of recourse, and the rates they'll give you a $40-50 million loan right now for like 3.25%, right? It's just ridiculous. Almost like free money, in my opinion. So before we buy, and a lot of this, so as a forward, I'm a fairly conservative guy. So before I go buy something, before I go do something, I'm usually take a bit more time than other people to look through and make sure I'm comfortable with things. So that's me. It may not fit everybody, but I'm just giving my point of view. Okay, so before I buy in any state or a metroplex, right? I would usually spend a lot of time to get to know the area, to look at a lot of deals that are coming out before I actually make an offer. So for me to expand to a new area, it'll probably take me anywhere from 3 to 6 months before I feel comfortable enough to start making bids. It's quite important to get to know the market that you want to invest in, right? But even before you go out to look at it, you kind of have to define what kind of buyer you are, okay? So what size of property am I buying? Roughly what is my purchase range, right? So if I'm a buyer that's looking at $1 million to $5 million deals, then I kind of know that, okay, I'm buying up to about maybe, 50, maybe 60 units, right? And then, one thing to ask yourself is, are you somebody who's looking for a lot of cash flow, okay? Or are you somebody who's looking for a lot of appreciation, okay? What does your investors want to do? Are they looking for cash flow? Are they looking for appreciation? Or do they want to mix up both? Okay, so knowing that will then you can help you narrow down what kind of areas that you want to invest in. So if you're an appreciation type of guy, you're probably going to be looking in San Francisco. You're probably going to look at Austin, okay? Places like that with a lot of appreciation, but the prices are going to be so expensive, you're not going to get much cash flow out of it, okay? Whereas if you're very interested in cash flow, just want a steady, 6 or even 8 or 10% cash flow, then you may be looking at, some areas that where the places are much cheaper, right? You're probably looking at Indianapolis, you're probably looking at Louisiana, some basically the Midwest. There's a lot of areas with that's still quite cheap, and you can probably buy something at an 8 cap or 10 cap, right? So you can get cash flow. So kind of figure out what you want and what your investors want, okay? And then go learn the market. So my investors are interested in what we call a hybrid deal, okay? So they want cash flow on day one, and they want to be able to see some appreciation, okay? Doesn't have to be crazy appreciation, doesn't have to be crazy cash flow, but we typically like deals that have cash flow day one that provides us with cushion and still have things to improve so we can have further room for appreciation down the road. Okay. So, areas that fit that profile, okay, would then be like Dallas, would be someplace like Atlanta, Georgia, Florida, these kind of markets that have both. Okay. A key metric that we look at is, does that market have population and job growth, okay? Because in order for an apartment to appreciate in value, you really need a place that has more people moving in than there's housing for, okay? And that's how the average selling price of homes will be forced to be driven up. So that's a key metric. You may be able to find some really cheap deals, out in smaller metros, okay? They're really, really cheap. And well, there's a reason for that. There's a reason why they're so cheap, because maybe the population is not really growing, okay? Maybe there's not as many jobs there that's increasing. So you can't really squeeze an extra $50 or $100 out of your tenants if there's not more jobs available in that area, right? So we like Texas, we like Georgia, we like Indiana, these type of places, because like for example, Texas on average is growing. Dallas-Fort Worth is growing by 100,000 people a year, right? So they have a pretty good 3% population job growth. So that's a really strong area to invest in. Okay. So once I kind of decide like the metro that I want to invest in, I like to travel. So I like to go there. I like to drive all the different neighborhoods. I'm sure you guys all know that no matter where you are, even within the same city, it's like you have really good areas and then you cross this one street and then it almost turns into like a ghetto, right? So within a city, neighborhood by neighborhood, things will be very different. And pricing and the kind of tenants that you get will also be very different. Okay, so I like to just drive around if there's enough time, drive around. And one thing I like to do is sit in a McDonald's, okay, or sit in a Starbucks. And then if you just sit there and then you just work on your thing, you can kind of watch the people that are coming in, right? So within 15, 20 minutes, you have a pretty good idea of your tenant profile. The people that's going to McDonald's, that's going to Starbucks around the area, these are pretty much your future tenants. So yeah, so best way to get to know an area is to sit and go sit one of these retail establishments, and if you see like it's a lot of if you see it's a lot of people who are not very well dressed, and then those people might have a lower chance of paying rent on time, right? If you go to some place where everybody's all dressed up, look very professional, nicely done hair, those people may actually rather buy a single family home than rent. Okay, so you're kind of looking at the middle income people, right? You're looking for the workforce, the working class people. Okay, that's what we typically invest in. Then that's what we look for. If you're buying a Class A area, you're probably looking for a younger crowd with more entertainment around, with newer maybe like tech jobs, that kind of things. That's probably what we prefer. Okay. So we can go to an area, we can kind of look at the area, we can guess what we think the neighborhood is and how well the tenant is, right? But the property management companies that do this day in, day out, they will be the experts. Okay. For example, like the property management company that I use in Dallas, they manage 27,000 doors, about 170 apartments in the whole Dallas Fort Worth Metroplex, right? So they know every little neighborhood. They know what the tenant profile is. They know like, okay, how much rent should you be able to collect in this neighborhood, right? So they're the people that you want to talk to. They will know, let's say you're looking at this apartment and you say, hey, they are charging $1,000 for a 2-bedroom now. Can I bump it up to $1,300? And then they'll tell you, yes, that's very doable because I have a property next door that's achieving that. Or they'll tell you, no, that neighborhood is bad. You charge $1,000, and half of them won't pay, for example. Okay, so talk to large property management companies. They are the experts in the field. Okay, and I use them extensively. When I go to a new area, I'll scope out 3 to 4 of the largest ones, and and just hear their opinions, okay, on some of the potential properties I'm looking at. Okay. Also, you need to meet the listing brokers. So commercial multifamily is different than residential. Okay, so these are 10 million, 20 million, $40 million transactions. So the buyer pool is very different. Okay, so they're mainly selling to syndications, they're selling to these real estate REIT funds, they're selling to like a private equity firm, basically high net worth groups of people. Okay, and so they're not selling to like anybody that's single family off a street type. They're more concentrated. So we'll find is in a metroplex as big as Dallas Fort Worth, 80 to 90% of the deals go through the top 6 brokers. Okay, they own all of those deals. So those people are going to be like your CBRE, they're going to be like your Marcus and Millichap, Arcadia, IPA, all these kind of large national commercial property brokers, right? So when we buy properties, we don't use a buyer broker. Okay, so we don't use a buyer agent. When you're buying a $20 million property, you should know what you're looking at. You shouldn't need a broker. I mean, you shouldn't need a buyer agent to kind of tell you, hey, watch out for this, watch out for that. No, you need to know by the time that you're in these large assets. And plus, it's only the listing brokers that is direct to the seller, right? So any buyer agent that you use, all they do is really they forward the emails that they get from the large brokers. They just forward them to you and say that, hey, for forwarding your email, I'm going to charge you 3%, 3% commission, which is just silly. So if you use a buyer agent to bid on deals, you're automatically 3% disadvantaged compared to anybody else who's bidding, which means that you're going to lose, right? So on a $20 million deal, your offer is going to be 600 grand lower. I don't see how you're going to win like that. So get to know the listing brokers, right? Get to know them directly on a personal level. And then they'll remember you, and then you're more likely to win deals. Okay, and they'll call you for deals, that kind of thing. Okay. So before you go and actually start bidding on deals, you got to ask your question: what if I win? What if I win? If I all of a sudden win a deal, am I ready to close within 2 months, right? There's a lot of stuff that needs to be in place, right, for you to be able to close on a deal. Okay, so first and foremost, you need to have a property management company ready to go. So when you're looking at these deals, your property management company should be walking with you. They should be checking out the property that they're going to have to manage down the road, right? So they can give you their opinion of whether or not this apartment will be able to be run at a profit. Okay. You also need to get your lender lined up. Super important. Remember, lender is your biggest investor, right? So we typically get our loans directly from Fannie Mae or Freddie Mac. So before they hand out a $20 million check to you, they want to check you out, make sure you're a reputable guy with experience. They want to check out the deal. They want to check out the apartment. They want to look at all the financials to make sure it can support the business plan that you're planning to do. Okay, so the lender is the one putting down the most amount of money, so they are the most careful inspector out of this entire team. They will look at the deal much closer than you will. They will send out survey companies. They will send out inspectors for all your equipment. They'll look at sewers. They'll look at everything. Okay, so for you, if you're buying a large commercial asset, you need to have a pretty good idea of what kind of loan you'll be able to get. Okay. Remember, the most important thing about buying multifamily is once you are under contract to buy, you have to close. You have to close. If you get a reputation as somebody who's not able to close a deal, nobody wants to offer you another one. They're always afraid. Well, if I recommend to the seller that, hey, I think this buyer is good, and then you don't come through, they look bad, right? The seller get pissed off, and then they don't want to use a broker again. So reputation is everything. So you want to make sure you can close. So make sure you know what kind of loan that you're able to get. Okay. Brokers I mentioned. So brokers are, the relationship with broker is almost like a country club. Okay, so it's a tight-knit circle of brokers and buyers, right? And for them to kind of take you seriously, you need to make sure that you confidently put yourself in front of them. Okay, you're going to conferences, you're calling them up, you're chatting with them about what you're looking for. You're putting in offers, right? So brokers want to work with people that are really acquiring property and not just kicking tires and just trying to check out how the market is. So let them know you're serious. They'll probably sell to the guy that if there's two equal buyers, they'll probably sell to the guy that they just had lunch with, like 2 weeks ago, right? So do meet them either in their office or just have coffee with them, etc. It's about building a personal long-term relationship, right? This is somebody that will probably be bringing you deals for the next 5, 10, 20 years. So the listing broker is super important. Okay. And then other parts of the team that I also build up, I have a property tax consultant that I rely on. So in Texas, property tax is one of the major expense in running the property, right? So when buying a property, I will ask my consultant to estimate, where do you think the city is going to be taxing this property, right? And they protest property tax all the time. They know exactly. They know all the city officials and the assessor. So they know exactly, they usually come really close in terms of like where the property tax is going to land once you buy the property. And with that being your largest expense, you need to know this ahead of time before you actually go buy it. Otherwise, it's going to come out as a surprise where you thought that, oh, property tax is only going to be 200 grand. But after you take over, property tax becomes 350 grand. You're not going to be able to absorb that, right? So it's super important to evaluate your property tax closely. Same thing with insurance. Insurance is, probably third highest expense on your property. So insurance, right now, insurance have been just going up every year. You saw the Texas freeze that happened. There is some, fires in California, tornadoes in Midwest. So lately, the insurance company has to pay out quite a bit, and they've been raising the rate to compensate. So get a quote, get a quote from your insurance company, give them the address, and they will be able to give you an estimate of where they think the insurance is going to cost. Okay. And finally, we have a SEC attorney. The SEC attorney will be able to draw up, your LLC formations and all these things, right? So you want to have them ready to review documents. So for example, like, let's say you won a deal, right? And now you're kind of reviewing the purchase contract. You want your attorney to be ready to look at these things to see if there's anything missed, right? Yeah, so make sure you have these kind of fleshed out. You have these people available, okay, before you bid on deals. Otherwise, you may be getting into a very different situation than, what you thought on your own. So, like I said, the first two are super important: property management company and lender. Like the lender I use probably has done all the loans on this property for the past 20 years. And the lender I use is called Old Capital. And the leader's name is Paul Peebles. We call him the godfather of Dallas multifamily. So he's done so many loans on these apartments, and he knows everybody. So he'll know where the skeletons are buried and, what is the problem with certain properties. So he's worth his weight in gold. I mean, he's gotten, he steered me away from troubled properties and, recommended good ones. So, in every metro, there's going to be somebody like that. Find that person, make him your friend, and you'll have much higher confidence in your acquisitions. Any questions? I'll stop for a quick minute and see if there's any questions. You can sit in chat, or you can just go ahead and speak up. Okay, if nothing else, I'll keep going. Okay. So that's on the buying side of things. And then you also want to build your network, okay? So building your network is extremely important. I already mentioned about the multifamily broker. Without a relationship with multifamily broker, even if you get listings, even if you're submitting offers, chances are you won't be able to be picked, okay? So right now, the market is a little bit different. Right now, money talks, right? So sometimes even when you have a really good relationship with a broker, but the competitor's offer is like $1 million above yours, no amount of relationship can overcome such a large difference, right? So, but having a good relationship with broker, you'll be able to hear about off-market deals. You'll hear about like, hey, a lot of the inside stories, right? So it's quite important. Another important thing is to meet fellow syndicators or fellow people who are actually buying properties in the area, right? This is twofold. Once you have bought a property, so what I like to say is like, we're all we're all enemies when we're buying properties, but we're all the best of friends after we have bought our properties, right? These are people, we rely on each other to, share what's the best information. Like, hey, I'm looking to replace my roof. This guy is really reliable and he gave a really good price, right? So we'll share that kind of information. Or for example, like, hey, right now we're unable to evict people. Do you guys have some tricks, or, are you guys doing something different? So the syndicators actually become your best friends, and you'll be able to improve your daily operations significantly with if you have good relationship with fellow people in the business. Okay. So also, when we're buying $10 million, $20 million properties, you're probably need to put a third of the money down, right? So if you're buying a $10 million property, you need $3 million, okay, to put the down payment as well as any improvements that you need, right? So I don't have $6 million lying around for me to go buy apartments, right? So, it's a team sport. We form a syndication and we go buy these large assets together and earn profit together, right? So you want to build up your network of investors that will come with you and take down these large projects together, right? So yeah, so you don't want to offer, you don't want to make an offer on an apartment when you're not sure if you have the funding to close it, right? So let's say you are looking at a $5 million deal. You need to bring in, about 1.5 million. And then you go, okay, maybe I can do it. I'm not sure. And then when time comes time to close, you're only able to raise 1 million. You're $500,000 short. Guess what? The brokers don't care. The sellers don't care. It's up to you to come up with that, whatever amount is missing. Okay. Once again, if you don't close, not only do you lose your earnest money that you put in, you'll also, the brokers also won't ever talk to you again. So, because you wasted their time. Right. So make sure that you have the funding. You have high confidence of getting the funding before you actually go and buy a deal. So where do you meet these brokers? Where do you meet the syndicators and investors? So this is, you meet a lot of them at these multifamily conferences that I spoke about, like, for example, the one that just happened in Dallas. There's also a few mastermind groups around the country. Okay, I wouldn't say join the program, but at least go there and kind of meet the people who are in the industry. Those people are always looking for passive investors. So I'm sure, you can go talk to anybody, learn some information from them, and build up your, once you acquire properties for yourself, well, then these are your syndicator friends that you can rely on. So also go to meetups. I met a lot of fellow friends at meetups like this one. So yeah, get yourself out there, right? So. And finally, it is actually very useful to build up a network of contractors. Okay, by contractors, I mean like roofers. I mean like plumbers, like electrical contractors, these kind of stuff. Because before you acquire a property, you may notice that, hey, this property looks great, but the roof needs to be replaced. Well, how much is that going to cost, right? I'm not a roofer. I don't know the exact pricing, but I have, roofers that I'm familiar with. So even before I put an offer to the buyer, I'm already getting estimates about, like, okay, yeah, I need to raise about, I need to allocate about 200 grand to replace the roof. Okay, I need to allocate about this much to redo the sewer pipes that looks like it's, constantly backing up, right? So having these contractors even before you purchase is really powerful. That will make your financial projections a lot more accurate. So there won't be any surprises. Okay. So answering a question from chat, what are the criteria you use to acquire your team? A lot of it is actually based on size, okay, and from talking with them. So property management company, the small ones will say anything to get your business, right? So if you talk to a small one that's only managing 200 doors, everything's great. Okay, yeah, this apartment you're looking at, oh, you're gonna double in 1 year. They'll say things like that because they're desperate to grow their business. Okay, so you actually want to look for large established companies. Property management being the case, right? For lender, I usually look for people who has been lending for a long time because they know the buyer, they know the sellers, they're able to bring you into deals. So the seller is going to ask the lender, hey, this guy's trying to buy my property. Has he worked with you before? Is he qualified for a loan? Should I trust what he say? So they actually reach out to the lender a lot. Okay, so, and I do the same thing, right? So brokers, you're looking for people who have a nice deals. You don't go for small brokers. They more or less pick up the trash that nobody wants, and those trashy apartments tend to have financials that you just cannot trust, right? So don't do that. Okay, and property tax, insurance, all these are size. Yeah. Okay. So before you submit an offer, okay, so what kind of preparations do you need? Okay, so one of the first thing that you want to do is make sure you are able to get a loan, for the property that you want to buy. So to qualify for your loan, typically the lenders will ask you for a PFS statement. So a PFS statement is proof of financial statement. Basically, they want to know, what is your net worth? How much liquid cash do you have? How much real estate holdings do you have? Are you subject to a lawsuit? Are you, all these kind of stuff. They want to know your background. Very similar to, what you would need to provide if you were applying for a mortgage, for example, on a larger scale, right? So you also want to make sure that you have a partnership agreement already in place. Usually you won't be acquiring these large assets alone, okay? So for example, if I went to buy a property and I'm the only sponsor, while there's 50 investors that's investing with me, what if I get hit by a truck tomorrow, right? There's nobody to continue operations. And at any rate, it's way too much work for me to take on a loan, and too much financial qualification for me to qualify on my own. So syndications typically have anywhere from two to four partners, the general partners that lead the deal. Okay, so one of the hardest thing when you're doing large deal is finding a good partner to work with. Okay, we would like to say that there's so much money, there's so many people wanting to invest, okay, that money is easy, partnerships are hard. Okay, it's literally a marriage. Okay, you're going to get into arguments with these people, with your partner. You're gonna have differences of opinions. Are you able to resolve them, right? Are you guys able to talk through problems? Are you guys going to be fighting each other over whose investor is this, those kind of things, right? So, and you want to do more than one deal with your partner, right? So it's a long-term, it's really a long-term. I mean, the bank also want to see you always working with the same group of people, right? So it will be kind of weird that you're kind of changing partners every deal, right? So they want to see you grow as a strong partnership. So pick your partners carefully. These are people you want to work with for the next 10 years, 15 years, the more that you guys grow. So yeah, treat it like almost like a roommate relationship. You guys are all friends until you guys live together. So, okay. Another thing that you want to prepare is your real estate resume, okay? So the lenders want to see, do you have experience in multifamily, right? Have you operated a deal this size before? Okay, so if you are saying that I want to buy a 200 unit property, but I never had any experience in multifamily, they're not going to give you a loan, right? That's way too risky. So they want to see that you have at least passively invested in apartment deals. This way you had exposure, how it operates, what's going on, right? But if you're trying to buy a large multifamily asset and all you have are single family homes, it's hard to get qualified, right? So it's perfectly fine not to have multifamily experience, okay? You can gain it in a number of ways, right? So you can do what I did, right? So, I started off by investing in other partnership deals passively, right? This way I can learn how it operates. I can have real estate experience I can put on my commercial resume. And in a way, I'm getting paid to learn how this works, right? So I'm invested into a deal, I'm getting cash flow, and I'm learning for free. I'm learning live on a real property, right? I can see the financials every month. I can see how it operates. So I'm getting paid to learn while building up my resume. So that's really good. The other way is you can, if you don't have experience, you can always partner with somebody who have experience. Okay. So you need to offer something to the group, right? Maybe you're able to bring funding into the group. Maybe you'll be helping to manage the marketing side of things or the investor relationship side of things. Maybe you can handle the daily operations, right? So if you have some kind of value add that you can bring to the group, then some of the groups out there may be willing to take you in under their wings, and you guys can acquire a deal together. And now you have that multifamily experience to put on your resume, qualify for loans, and do your own deals. So, so build up that resume. It'll help you to qualify for loans and do larger deals in the future. Okay. So, make sure that you have where's the money, where's the remainder of the money, right? So if you're going to go buy an apartment, where are your investors going to come from? Where are your funds going to come from, right? Is it you that's putting in all the money? Do you have an investor group that has invested with you before that you can bring in to bring funding to the deal? Okay. Or are you going to go out and get an expensive hard money loan in order to do the deal, right? So, but whichever way it is, make sure you have it ready to go before you start making offers, right? Because you don't want to make an offer where you can't get the money, right? So, okay. The other thing is, typically on these deals, the seller wants to see you put down some earnest money to make sure you're serious, right? So if you're buying a $10 million deal, you're probably putting down $100,000 to $150,000 to guarantee that you will close on the deal. Okay. If you back out for any reason, if you, if you cannot get the funding, if you cannot get the loan, well, then you lose $150,000, right? So this is a way to make sure you're serious. It protects the seller. And then it also, if when all deals are equal, the person that is more serious, that puts in more non-refundable earnest money tends to win in the current market. So keep that money liquid. Okay, so within your group, make sure that you have that money ready to go. It usually goes like, as soon as you have a contract ready and agreed upon, that earnest money usually need to be deposited very early on in the acquisition cycle. So you want to keep it liquid. You don't want to have to sell home in order to have that money. Okay. And also, it'll be good to have references, right? So if you have worked with a lender before, if you have worked with this broker before, they'll be more than happy to send you a reference saying that, hey, Tony bought a property from me before, and he closed his deal very quickly. He was very communicative. I recommend you. These recommendation letters are very helpful, especially when you're going to a new area where nobody knows you. Okay. But also the brokers all talk amongst themselves. So, if you do things well, people know you. If you do things bad, they'll know literally the next hour. Okay. So if you fall apart on the deal within an hour, all the brokers in the area will probably hear about it. So, yeah. So that's why I said that, if you don't close on a deal, everybody knows, and you'll be shut out. Yeah. Okay. Any questions? All right. Moving on. So what happens when a property comes on market for sale, right? So before a market is actually even announced to the world, the brokers are calling their most reliable buyer groups, okay, and telling them that, hey, I have this deal, it's coming on the market, okay. You want, are you interested? Because maybe the seller wants to close really quickly, right? So like right now, there's some sellers that want to close by end of a year, so if you're able to, if you have all the money lined up, if you have like lenders approval already ready to go, then they'll offer you the off-market deal, okay? Because they know that you're able to take it, do a very quick analysis, make a decision right away, and be able to close. So, so usually, even before a deal goes market, some folks already know about it. Okay, not all, because for sellers who are patient, they want to go through the full 3-month selling process to get the most amount of money that they can. And this goes back to, when I say that go meet your fellow syndicators, okay? Go meet your fellow apartment owners, because guess what? These people eventually one day, they're going to be selling their properties, okay? So a lot of deals, you hear a lot of these deals through the grapevine that way. So if you know that, hey, this person owns 3 properties, okay? Check up with them once in a while. Say, hey, do you want to sell this one property? If so, I'll buy it right off from you, right? Just sell it to me. We'll do it off market. And that's and that's really powerful. So make sure that you're always building friends who own properties, and you can probably buy it off of them without having to compete with the whole world. So once the off-market period kind of finishes, the brokers would send an email blast to all the registered investors that they have, right? So these will literally go out to like 10,000 groups and individuals, right? To say that, hey, this deal is on the market, contact me if you're interested. Here are all the financials, the past 1 year financials. Here's a rent roll, who's living in there. They'll provide all the information. Okay. And then once that email goes out, there's usually a 1-month marketing period. for people to review, to tour the property, to check out the different things, right? So, yeah. And during this time, some people may find the deal so attractive that they want to send a preemptive offer. Okay, meaning, even before the bidding starts, you say, hey, I'll just buy your deal for 10% above what you think you are going to get, right? So you try to preempt it. Okay, so usually the seller, unless you give a very convincing offer, they'll usually, take it through the whole process, right? So, so during this time, you're constantly talking to the broker. Hey, how motivated is he to sell? Hey, why is he selling? Or, what other, do you think it's worthwhile if I put in a preemptive offer for 18 million? Is that even in the ballpark? And then the broker will tell you, and they'll usually tell you like, okay, what price, if you're able to offer what price, you should be able to win it. Okay, so yeah, talk to your broker. They will be able to shed a lot of light. Okay. So after 1 month of marketing period, it goes, in a good seller's market, the offers go through multiple rounds of bidding. Okay. So usually first round, you'll probably end up with like 30 groups all bidding on a single property. Okay. The reality is only about 5 to 10 of them will be considered serious by the broker. All the other offers will actually, will just be rejected because, either the broker don't know who those people are, or don't think that they're able to raise the funding, or they're just kicking tires, right? So after the initial round of offers, you'll probably end up with about five groups that made it to the best and final. Okay. In the normal world, the best and final means the best and final, right? But now it's best and final, and then the best of the best and final, and then best of the best of the best and final, things like that. Not always like that, but generally what I found pretty common nowadays is there will be a first round, okay, and then within a day or so, they'll tell you whether your offer is accepted to join in the best and final round, okay? And usually your broker will tell you that, will tell you where that line is, okay? So if you made it to best and final, they usually send you a questionnaire, okay? This is where they're gonna ask you, what is your business plan? How much money are you planning to raise? Where is that money gonna come from, okay? Do you already have your loan yet, right? Does your lender know about the property? Who's gonna be managing the property? And then they're gonna ask you like, okay, well, within the past few years, have you bought any properties, right? This is where your real estate experience comes in. So if you say that I'm very active, I bought like, 2 properties in the past 3 years, so I'm actively buying, I'm actively closing, well, then you're a qualified buyer, right? So the seller will usually review the questionnaire. Some sellers actually want to talk to you, so they'll set up an interview, okay, where they'll ask more of a questions, and then really trying to get a feel for you of whether or not you'll be able to close, right? Do you know what you're talking about? If you say you're going to build a car wash on the property and generate revenue, they're going to laugh you out the door, right? So, but they generally want to just hear about your plan, and they're trying to gauge whether or not the lender will agree to your plan. So, you may have the most optimistic projection in the world, but the lender would go, nope, sounds nice, but I'm only going to give you this much, right? So they're trying to gauge, and once again, that's trying to gauge whether or not you'll be able to close the deal as you expected, right? And during this time, you'll want to tour the property, you want to go check it out for yourself. All the marketing material is going to look super pretty until you go see the property yourself, right? And during the time that you're walking the property, you'll want to be looking at issues with roof, issues with foundations, any sewer, any, boiler, AC system issues that you can see, because those are going to be the large capital expense that you need to factor in. Okay, so sometimes I bring my property management company with me, right? So they have an even better eye for what could be wrong. But yeah, for me, I walk a lot of properties on weekends. I visit the properties in the Bay Area just to practice. So if you're interested in coming with me on one of these trips, let me know, and then we can probably arrange something. And that's the best way to learn, in my opinion, just to see what type of properties are out there. Okay. So now you kind of walk the property, you know what kind of large expenses there are, you hear the marketing spiel. Now it's time for you to prepare how much you're going to offer, right? So what you want to do is you want to look at the trailing 12 months, okay? You want to look at, what is their financials for the past 3 months? Are their rents in an upward trajectory, or is it dropping, right? How's their occupancy? All these kind of stuff. So you want to analyze that. Like I said, this is called underwriting. And I can have 2 sessions just talking about underwriting alone. And it is that important because you want to be accurate with your number. So, so there's no surprises after you buy. Okay. So you want to be getting your loans, okay? You want to be pre-qualifying for loans because maybe you thought that you could get like a 75% loan, leverage loan, and then the lender comes back and tell you, nope, based on the financials, I can only offer you 50% loan, right? Well, that kind of wipes out your whole deal, right? You don't want to realize that until the end, right? Okay. I also asked my property management company to send me their projections. Okay. So I want them to give an estimate of like, if I let you run the property, how well are you going to perform? Okay, so they usually give a projection, and I'll usually stick them to that projection. Say, hey, this is what you promised. You have to deliver on these kind of returns, right? And plus, they know the market better. So maybe you thought that you could raise the rent by $300, and then the property management company is going to come back and say, no. This property, you can only raise it $70, for example. They'll pull you back into reality. Okay. I'm also asking my property tax guy, what is the property tax I can expect, to pay? I'm getting my insurance, and I'm getting quotes from some of the vendors on like, hey, for that property, can you do a drive-by? Give me a ballpark figure about how much you think it'll cost to replace a roof or something. Okay. Once you have all these data points together, then you can do a pretty good estimation. And based on that, you can project how much you should be offering on the deal. Okay. Sujith asks, when can we get financial statements from the seller? Well, if you're buying from a reputable broker, you'll get it on day one. On day one, as soon as they announce a deal, all the financial statements will be there. Okay, that will include their trailing 12 months of profit and loss. That will include a rent roll of every single tenant, how much you're paying, and what is the market rent. It'll be on there. And they will usually have an offering memorandum, which is a marketing sheet that tells you what are the potentials. They'll do an introduction about the area that tell you why you should buy this apartment and not the other one, right? So they'll have an offering package when they bring it on the market. Okay, so I personally wouldn't buy any deal where I would never put an offer if I don't have the financials. Okay, just no way. I mean, without the financials, I'm completely blind. Whatever you offer just would not make sense, right? I need a reliable one. So these national large multifamily brokers, they will review the financials from the seller, and if the seller is shady, they won't even take him on. Okay, so because their reputation is on the line. So I feel confident working with the national brokers. And then some of the deals that you see offered by the smaller brokers, or if you see a deal on LoopNet, there's usually a problem. There's some hair on the deal. There's usually some problem that they're hiding. Okay, that's why none of the large multifamily brokers will take it, and they fall to these smaller brokers, or it goes on LoopNet, right? But my issue with those is you don't know if you can trust the financials. They could be overrepresenting how well the property is doing. Okay, looks like everybody wants field trips. We'll see if we can get that one going. Okay, so you have gathered all the information that you want, okay, and now you're ready to submit an offer, okay? So, on a typical LOI, letter of intent, that's what we call an offer, okay, a letter of intent. It will have the following major things, right? One is who's buying the deal? Who are all the partners that is going to be purchasing the deal? This is important because they want to know if you guys have experience or somebody that's brand new. Okay. Next, of course, a purchase price. Okay. And then after that, you want to talk about like how much earnest money you are going to be putting down to guarantee that you'll close the deal, right? And also, you also talk about like when does that money become non-refundable? Okay, so sometimes it's after the inspections are done that becomes non-refundable. Sometimes it is after the title insurance verifies everything's good, and then sometimes it is literally like day one. Okay, day one, you guys sign the contract, the earnest money is non-refundable. So that's what happens in a seller's market. Sellers can ask for anything that they want, right? You won't see earnest money when it's a buyer's market. So it's all market dependent. Okay. So you also negotiate with them on how long the due diligence period you have to review the property, right? So remember, before you buy, you get about 30 minutes to an hour to walk the property and get a very quick sense of the property, right? After you purchase it, you are now going to call in every single contractor that you know, your electrician, your plumber. They're going to climb on the roof, okay, go inspect every little thing and then tell you everything that needs to be replaced. Okay. The roofer is going to say that your 1-year-old roof needs to be completely torn out and replaced with something brand new, right? But you're just trying to get quotes. You're getting quotes. You're trying to find problems that you didn't know about, but usually you know about the big items. You're just looking for the small problems. During due diligence, you'll also have your property management company will walk every single unit on the property and write down what is a condition, what things need to be replaced. Okay, so if it's a 300 unit property, they'll send out 4 guys and then they'll have it completely walked within 2 days. Okay, they're pros at doing that, and they'll generate you a nice report on all the things that need to be replaced. This is how much you need to budget for to fix the issues on the property. Okay, so due diligence period, anywhere from 2 weeks to 3 weeks, right? If your earnest money is already non-refundable, the seller doesn't care. The seller really doesn't care. I already have your money. Yeah, go ahead and inspect it for the whole. Go inspect it for the whole 2 months if you want, right? It'll already cost you too much money to back out, right? You bought the deal at that point anyway. So go ahead, So they're usually very, very cooperative. Okay. And then finally, you want to have a clause for yourself in case things go bad, right? So for example, right now, if you're trying to get loans, it's toward the end of the year, there's actually a lot of activity and the lenders are falling behind, okay? Originally, you have said that, well, it'll only take me 60 days to close. But, at day 60, your lender is not ready. Then usually you put a provision in there to say that, okay, I have the sole option to increase the closing time by another 2 weeks. Okay. So, but every time that I extend it by another 2 weeks, I'll give you a little bit more earnest money. Okay, to guarantee that I'll buy the deal, right? So, I think the record that I saw was somebody extended the deal for 6 months, okay, and put in an extra $2 million in earnest money to make sure the deal gets done. I mean, he already has like 4 million earnest money in the deal, so it's like he can't afford to lose the first 2 million. So, yeah. So that's what a typical LOI would have, and the seller will pretty much know all the most important thing to decide whether or not you move on to the round or whether or not they want to accept your offer. Okay. So everybody submit their LOIs. Finally, the broker and the seller picks an offer to accept. Okay. Remember, the broker has a tremendous influence on the seller. Okay. Because they're the ones that know whether or not the buyer is reliable. Okay. So they have a lot of influence. I would say 50% of the decision is actually going to be from the broker. Okay. Of course, the seller can override them, but most of the time they trust the opinion of the broker. Okay. So now you have your LOI accepted. The clock more or less kind of starts now. Okay. So typically, let's say it is 8 weeks, to close a deal. This is what that schedule looks like. Okay. So at week 0, you're basically negotiating the purchase sale agreement. That is the real contract to buy the deal. Okay. In there, they'll talk about like, hey, what do we do about the rent that haven't been collected yet? Okay, how are we going to share that? How are we going to split the property tax? What about the utility money that haven't come in yet? Who gets that, right? And then, so basically all the finer details will be worked out by the lawyers. Okay. They'll initially send a draft demanding the whole world, right? And then you'll cross it out, and say, nope, I reject this. I want to add this, and then you send it back to them. And then they will come back and forth. And usually it takes about a week, sometimes a week and a half, to negotiate what the final contract looks like. Okay. So, how exactly are we going to carry out the sale? So once everybody's finally agreed and then the contract is signed, that's when the 2-month closing period, this is how the 2-month closing period starts. Okay, so this is why it's called this week 0. So during week 1, now that the contract is the purchase agreement is accepted, okay. Once that is accepted, everybody signed. The earnest money now need to be deposited right away, okay. And usually it becomes non-refundable at this point. Now that you have a contract you guys agree with, okay. So week 1, the buyer is also applying for the loan, starting that process. The loan is the longest task in this closing period. Okay. So week 2 to 3, you're doing your due diligence. You're visiting the property, you're getting quotes from your contractors, you're basically finalizing the cost of acquiring this property. Okay. And you're going to create a LLC that's going to be where all the investors will own, will be and own part of it, right? So the LLC will own the property and the investors will own the LLC. Okay, so it takes a week or two to set this up. So usually that gets kicked off. Okay. So by week 4, you have already finished your final due diligence. You've gotten your quotes. You've already set up the partnership. So everything's ready to go. So you would then at week 4, finally present your business plan to the investor. Okay. So note that by this time, you have already put down maybe $200,000 to $300,000 of your own money. Okay. You needed to put down your earnest money. You needed to pay for the loan origination. You needed to pay for some of the inspections, etc. Right? So there's a lot of out-of-pocket money for a sponsor in the beginning of a deal. Okay. So by this time, week 4, you had the final numbers. This is about as accurate as it gets. And now you're comfortable sharing the business plan that you're now going to execute, right? So you would do a webinar, you would do an in-person event, whatever it is, you would present the deal to your investors, okay? The investors didn't have to put a single penny at this point. The sponsor is taking all the risk, okay? So that's why it's important to make sure you have your investors lined up. Otherwise, you lose your earnest money. Okay. So once you have presented to investors, the investors who are interested will now, sign to be part of the partnership, and they will wire the funds over the next 2 weeks to acquire the property. Okay. During this entire time, the lender is going to ask for nonstop documents. Okay, they're going to ask like documents on the property. They're going to ask for your qualifications. They're going to want to see the proof of your funds. They want to see your syndication documents. They don't want to see everything. Remember, I said that they're very, very careful. So half of the stuff the buyer has to provide, but majority of stuff they're looking for is actually going to be provided by the seller. Okay. What are the laundry contract? What is a cable contract? What is the electricity, billing like, so the lender wants to see all that before they give you the money. Okay. And then finally in week 7, week 8, by this point, you have all the funding necessary to close the deal, to buy the deal. If you're short, this is your panic period to go look for investors or figure out how you're going to fill the hole yourself. That's probably going to mean that if you're short by 300 grand, well, you're going to have to put in 300 grand of your money to make sure the deal closes, right? So that's why make sure your underwriting is accurate. So, and then week 7, week 8 is when the bank finish everything, start signing documents, send everything, the escrows are done. They're going to ask you to send in money set aside for repairs, all that kind of stuff, right? So, and then finally close on week 8. Okay. I know that was a lot to digest. You guys probably didn't think it was this many steps to buy an apartment, but the good thing is most of you don't ever have to worry about it. You just have to find a sponsor that you trust, invest with them, and then watch him work himself to death while you just collect money. So any questions before I move on? Okay, moving on. All right, so now that the property is yours, Now that the property is yours, then the next set of stuff to do is to take over the property, right? So you're gonna go in there with your new property management company. First thing you're gonna do is change all the locks, okay? Make sure that the previous owners or their staff cannot get at the items. You're going to review the inventory list, all the stuff that they were supposed to leave you, okay? Make sure they didn't take like a power washer, they didn't take a sewer declogging machine or something like that, okay? Those are supposed to transfer over. Okay. So now you're gonna have a new office team and a new maintenance team. Make sure that you train them, okay? What your expectations are, okay? You also set up like, are you gonna be doing a weekly call with them? Are you gonna be doing a bi-weekly? Or you're gonna be one of those people that really trust their property management company and just don't do anything and just get a month-end report and just look at that. So up to you. Different people. I tend to be very hands-on. Okay. One of the most important thing is make sure all the contracts are transferred over from the previous owner to you. And this has happened. A lot of problems have happened in the past. Okay. Somebody, namely your property management company, forgot to transfer electricity billing over. Okay. And then guess what? In 2 months, the electric company shuts off the electricity to your whole property. And then your tenants get mad, refuse to pay rent, and then they leave, right? So don't do that. Make sure every contract is transferred, including some of the storage units that is on the property, okay? Those tend to be on a separate contract, and then if you don't realize it and you're putting your stuff in that storage container, they're gonna come and haul it away along with all your renovation materials, and then they're gonna hold it ransom until you pay them a really large sum of money. This has happened. It literally, it took 2 months for them to get it back, and all the renovation process was stuck for 2 months while they got that sorted out. They thought it got stolen, but yeah, nobody's gonna steal that thing, that's something that heavy. So once everything is transferred over, now you're ready to start on your capital improvements. So now you're getting your vendors to start renovating the units, telling your maintenance staff to, install the new appliances, maybe the backsplash, all that kind of stuff, right? It'll be a busy 3 months. The roofers are coming in, electricians are coming in, plumbers are coming in to now do all those renovation work, right? So, it's a busy time, a lot of things to keep track of, okay? You'll also want to do what's a cost segregation study. This is basically, for you to evaluate your property and get depreciation on the property, okay? So this has tremendous benefit to your investor. So for example, somebody who invested $100,000, under the current rule, you'll see an immediate depreciation of $70,000. Okay, that's a paper loss of $70,000 right away. Okay, which is great because that means that all your cash flow for the future years you don't have to pay tax on. Okay, and if you happen to sell another property and you have some profit there, you can use this to offset your rental income from that property. So it's a very powerful thing that we do for our investors. So we usually do a cost segregation study right away. Okay. And then it is your job now to operate the property for the next 3, 5, 7 years, whatever it takes to hit your exit goals. Okay. So during this time, remember, you need to keep your investors in contact. Okay, make sure they know everything that's going on. Make sure you're completely transparent. What I find is don't be afraid to tell investors if there's anything going wrong at the property. Most of us have owned single family rentals. We know it's an up and down thing, right? They just want to make sure that the passive investor, they just want to know that, okay, there's a problem, you're working on it. That's good to hear, right? For me, if I'm investing in somebody else's deal, my biggest fear is that that guy is hiding some problem, okay? And it blows up one day and I don't even know about it, right? So I only invest in deals where I know the syndicator is trustworthy and they send a monthly update, okay? This monthly update usually talks about how the property is doing, how are the collections, how's the occupancy, and they also send the full financials, right? What were all the expenses? What were all the income? What is our occupancy? All this information. So if you want to learn the business, the best way is to become a passive investor, invest in one of these deals, and then you can literally watch month after month how this property is operated, how that translates into financial performance. Okay. And depending on the syndication group, they may send out the profit sharing either on a quarterly basis or on a monthly basis. So we typically send it out on a quarterly basis. To do it monthly is just, takes too much resource away where we could be spending on, running the property better, right? So usually quarterly is fine. So you're sending out the share of the cash flow to everybody. So on these deals, you'll probably see anywhere, in today's world, you're probably seeing anywhere from like 5 to 6% cash flow. Okay. So because we operate most of these properties remote, so I usually fly into Dallas every other month to go check on the property and to look at new deals. When I go on the site visits, I'll be sure to take a lot of photos and share them with the investors so they can see, how the property is progressing. So I usually set up like a WeChat group, and this way it makes it much easier for me to just share pictures, share progress with people. Okay. Every year you need to file taxes for the property, and also for each of the investors, we send out a K1 for everybody, right? So basically for tax purpose, at end of the year, you have a K1 that reports your partnership income or loss, okay? And yeah, we usually try to get that done by March timeframe. So everybody has time to file for their taxes, okay? And you want to keep everybody happy, right? So I like to host regular investors get together, we hold parties and, and just get together and, talk about talk about how the market is doing and just really just investor appreciation. Okay. And finally, the happiest time to owning any property. Well, the two happiest time is when you buy it, and the next happiest one is when you sell it. So, so there's different exit strategies. You don't always have to sell the property. Okay. For properties that are doing really, really well, you could possibly just do a cash out refinance, right? And for the money that you have cashed out, you can use that to pay the money back to the investors. Okay. So for example, one of the deal I invested in, let's say it was 100 grand. After 2 years, the property was running so well. They were able to refinance and pull money out. So out of that 100 grand, I actually got 60 grand back through this refinance. So then my investment in the deal is only, the money I have in there is only $40,000, right? So now I can take that $60,000, I can invest in something else, and in a way make double the income, right? So that's how it's done. And when the market is right, or when we have hit our target, so our target is usually try to double everybody's money within about, I would say, 6 years or so. Okay, so if you put in 100 grand, our target is usually by year 6 or year 7. If you put 100 grand, you would have received 200 grand back at year 6, year 7. Okay, so that's a projection, so it could happen later, or it could also happen earlier, right? So if we go through a prolonged recession, maybe instead of exiting at 6 years, it'll be exiting at year 7 or year 8, right? Or we could have a really good market, or we have a really good property, and we could be exiting at year 3, for example, way ahead of schedule. So for example, that's the case with the property I'm currently selling. We originally projected that we're going to sell in year 6, but we've done so well that we're able to sell in year 3 in half a time. Okay. So if you decide to sell the property, you want to start preparing for it about, almost a half a year in advance, right? So what you want to show is a stable income. Okay, you're not trying to jack up the rent every month, and then because if you keep jacking up the rent, you might end up with like a 85% occupancy. You don't want that. You want to constantly maintain a 95% occupancy, okay, to show you that this property is stable, okay, and you don't need to raise rent. You leave the raising of the rent to the buyer, okay. And then you can probably do 1 or 2 sample units just to prove that you're able to get the rent that you're claiming. But yeah, other than that, just make sure the property is nice and stable. Okay. So when you're ready to sell, we usually, so when you're ready to sell, you usually will reach out to the brokers, okay? And the broker will say that, hey, I can sell your property, give me your financials. And they go, ooh, I can get you 17 million. The other guy goes, oh, I can get you 16 million. So they send out what's called a broker's opinion of value, okay? And the price that they're projecting depends on a lot of factors. People like CBRE, they will probably project a little bit higher because they literally have so many investors registered with them, okay? But there could be some people there could be a really hot broker that's selling a lot of deals in the market. Maybe you want to build a relationship with them. So you could give them this deal to sell, okay? And, it's kind of like, you scratch my back, I'll scratch your back, right? So if you give him a deal, he'll probably, sell you a deal, right? And this relationship just keeps going. Okay. So once you got the broker's opinion, you think that's a good price to sell at, then you will call the shareholders, all the limited partners that have invested, together for a vote, okay? So the limited partners actually have voting power within a typical partnership, okay? So if the lead sponsors are not doing well, then they can actually vote them out and replace them with somebody who's more capable, right? And also on any refinance or sell event, the shareholders get to vote to say that, no, we want to hold on to this property, continue the cash flow. Or there's somebody that says, there's some people that says, no, we made a lot of money already, let's sell it now. Okay, so we usually will call for a shareholder vote. Okay, I mean, we will. It's part of our partnership LLC agreement. Okay, and then finally, you would prepare the property for sale, right? So you would fix up all the little rotten wood. You would probably touch up paint everywhere, make sure the grounds are super clean every day. Any large capital items, that needs to be replaced, you'll probably do that. So for example, on the property that we're selling, I spent 120 grand to change out the roof. I think it makes it look much, much better. And, I'll easily get more than that back on the sale. And I also changed out some of the 2 large AC units, right? So the 2 large AC units were 50 grand a piece. So totally for 100 grand. But I was able to claim insurance on that because of the February freeze claim. So 100 grand, and we're gonna be able to get like about 65 grand of that back, right? So pretty nice. So anyways, you just want to prepare the property so that it has a good story on how the next person can continue to improve the property and be able to generate even more profit, right, after you. Okay. Brian asked, why is a typical hold 5 years? It's really based on the current returns that we're seeing in the market. So for a typical deal, I would say the yearly return is about 12%, 13%. It used to be higher, right? It used to be higher. It used to be about 15% to 17%. So it'll take about 5 to 6 years to double the money, right? Right now, with things that are a little bit more expensive, so we're probably looking at returns of, anywhere from 12 to 14% a year. So after 6 years, you're looking at maybe 84 to close to 100% return. Okay, so that's what the typical hold is. So even though the annual return, 12 to 14% has compressed a bit compared to before, but it's still a lot better than what you can get from the bank, right? And this is with cash flow and appreciation. So that's a nice part. Okay. And then finally, when you sell the property, it's the same thing we talked about in reverse, right? So what I do is, I actually do some extra things. So for example, when I go to conferences, I will try to spread the word as much as possible to make sure that we get more eyeballs on the deal. On the Old Capital Conference, I was able to get four more parties interested, and 2 of them toured the property the very next day, right? So more buyers mean a better price, right? And we also do basically an online review of the property. We talk with a lender, and then we talk through the deal. So that's a really good promotion as well. So, and then once we go through the full selling cycle, we're able to pay every investor back their principal plus the profit, and then we party. So that is the full sell cycle of multifamily. Okay, at this point, I'll open up the floor to everybody. Feel free to ask any questions that you want, do it in chat or through or open up your mic. Yeah, all those are fine.
Hey, Tony. Thanks for the session. It was really informative. I have a quick question. I am Sujit, by the way. And you said you don't want to have a buyer's agent, but as you are the buyer, you are not paying for the agent, right? The seller will pay for the agent, right? Mm-hmm. So why you don't want to have a buyer's agent?
No, so if I have a buyer's agent, I'm paying the 3%. This is, so the buyer agent, when they forward you a deal, they will say that you will now enter in a buyer representative deal with me, and you have to pay me 3% of the purchase price. So you're paying for it. It's not the seller.
Oh, okay. Is that the case for even small multifamily and single family? I thought it only the seller will pay for the hedging.
In commercial multifamily, the seller only pays for the seller broker. They don't pay for a buyer broker.
Okay.
If you ask them to pay for that, you won't even be considered. So yeah, in this market, yeah, it's a small group of people, so they usually will be able to buy deals without having a buyer's agent. So, if you're not sure what you're looking at, or if you're not sure that your numbers are good, or you can always ask one of your syndicator friends, or you can reach out to me. I'll be happy to look over your underwriting. I may not always be familiar with your area, but just looking at underwriting, and looking at their financials, I can give you a pretty good idea. Okay. Did you have other questions? I think you mentioned you had a few. Oh, I think he actually dropped. Okay. Gordon has a question. Before selling, do you cash out refi first, then sell? That's really situational. So for example, if you do a cash out refi, you now have you now have more interest that you had to pay, going forward, right? So you usually would not do a cash out refi, and then sell right after, right? So why do you want to pay for the loan cost and the trouble of having to go through that, right? So typically, if you want to hold it for a longer period of time, that's when you do a refinance. If you're ready to sell, then you usually just go ahead and sell. Do you have any stories on how you didn't meet the target returns? What were the typical issues that you now watch out for? So I think luckily, on each of my deals, I have hit my target returns. But I myself have invested in deals that did not hit the target return. And I also hear stories of other syndicators that did not hit their returns. Okay, so typically, I would say there's a few possibilities. Like one is usually when they're buying, in order to win the deal, they're overly optimistic about the kind of profit that they can achieve. Okay, so they will underwrite deals like, I'm assuming that they're going to underwrite deals like, oh, it's going to be a 7% rent growth every year. I mean, that's just not realistic. It's more like 3%. They're going to write something like, oh, the expense ratio is only going to be 40%. That's too low. Usually the expense ratio will be about 50 to 52%. Okay, that's much more normal. They might write something like, oh, okay, vacancy plus uncollectible rent, etc., will only be 5%, which is like really, really low. So I typically underwrite 10% to be conservative, right? That I usually assume that I'm going to lose about 10% of my money. I'm not going to be able to collect 10% of the maximum possible, right? So that's usually reason number one. The syndicator is too aggressive, okay, on their projections. Number two is usually when a syndicator is too successful. Okay, so there are syndicators that just start buying properties like crazy. You'll see that they are buying 5 to 6 properties a year, right? That's simply not sustainable. And the reason why they're able to buy 5, 6, 7 properties a year is because they're really overpaying, right? So what usually ends up is the group, their group of people is not able to watch over all these properties very carefully. Okay. In fact, recently there was a group that owned 12 properties that was not able. It was just like, a few, like three of them. They were not able to do a very good job watching over 12 properties, obviously, right? And they got flagged. Fannie Mae said that I will no longer work with you. You must sell every single property that is where you have my loan on, because I don't want you to do any more deals with me. So they were forced to sell their entire portfolio. And this is really because they expanded too fast. So you really want to make sure that the syndicator is slow and steady. I find that's much more successful. Otherwise, they're just so desperate to make money that they'll just buy one deal after another and keep telling people how great it is. And yeah, so slow and steady wins the game. So any typical issues I now watch out for? Yeah, so I would say making sure that when you do projections that you're conservative, right? So there's always going to be risk inside these investments, and the best way to mitigate or minimize that risk is to be conservative, right? So when we usually buy a deal, we'll raise like about 300 to 400 grand of extra cash just as reserve, right? For rainy day fund. So, mitigate those risks before you buy the deal, even if it means a lower return, but it's safer for everybody. Okay. Anybody else have any other questions? Okay. If there's no more questions,
Hi, Tony. I think I have one last question.
sure.
So I'm just wondering how involved you are with the whole managing those apartment, and like how would you deal with, like if tenant doesn't pay, or like if they destroy the apartment?
Okay. So for these large assets, we always hire a professional property management company. So they're always on site, and most of the daily operations they will take care of, right? So we act as the asset manager. So we, think of us as the captain of the ship, right? So we're constantly, I mean, I'm a little abnormal. I'm almost running the deal, the property management, almost on a daily basis, because I like to learn. I like to be really involved in my properties. So I would say per week, I'm spending about 15 hours per property. And then, so you set the tone, right? You set what is your expectation for making sure that we evict the tenants on time. If somebody doesn't pay, how much leeway do we give them? If somebody, what is the policy for the type of tenants that we accept, right? So as long as one of the ways to avoid tenants who are the type that will go and wreck your place is to make sure that they have good qualifications, right? So in terms of credit check, in terms of making sure he's earning 3 times the rent, okay? In terms of like making sure we're checking out his references from the previous apartment. So as long as you're leasing out correctly, you dramatically reduce the amount of trouble that you have with your tenants. Another thing that I asked my my office manager to do is don't just rely on the leasing agent on signing the lease. I made a requirement for the office manager to meet and chat with every single prospective tenant. Okay, so this way, you know how human, just from talking to somebody, you can get a gut feel. You can get a gut feel of like, is this guy going to work out or not, right? And the office manager that I have is very good at that. right? So she has a pretty good sense. So even though this person may qualify, but if a person feels shady, I'd rather pass on it, right? And this is different for every syndication owner, right? So some people just want to keep the place full. I don't care what kind of people I put in there. For me, I rather have quality over quantity. And because of that, my property actually end up being better because the tenants pay on time. They always renew, and every month, on 146 units, I only had to look for 2 tenants. There's only 2 move outs per month, right? So which is really, really low. So yeah, finding the right one in the beginning is important. So I'm very involved in my assets. Whereas, like I said, some groups, if they're very happy with how the property is doing, then all you have to do is, just check the online report once in a while, see how the property is doing month to month. And, if all goes well, you really shouldn't have to manage too much.
Sounds good. Thank you so much for sharing.
Yeah. Cool. Anybody else? Sure. So if you guys would like to, have any further questions, so feel free, you can go ahead and reach out to me. You can message me on Meetup, or, later on, I'll be sure to send out the slides and the recording. And so, you also have my contact information that way. So you can email me here at linkmultiinvest@gmail.com as well. So yeah, whichever way you like to reach out to us. Cool. Thank you, everybody. Take care.